In the mid-20th century, the world stood on the brink of a profound transformation that would forever change the course of history. Yet, in the midst of global uncertainty, few events had the far-reaching implications that would emerge from the Suez Crisis. It wasn't just about geopolitics, military action, or diplomacy, it was about something even more critical: the very structure of global trade, finance, and the future of international commerce. One of the most vital factors that triggered the conflict was the Suez Canal itself, a small but powerful waterway that would play a monumental role in shaping the world as we know it today. But why was the Suez Canal so critical? What made this narrow strip of water so important to the balance of power in the world? Let's rewind to the early days of the canal's history, long before it became the center of a geopolitical crisis. The Suez Canal, completed in 1869, was constructed as a direct link between the Mediterranean Sea and the Red Sea, cutting through the heart of Egypt. In a world where maritime shipping was essential for global trade, the canal offered a shortcut that reduced travel time significantly. For European powers like Britain and France, who depended on global trade routes to maintain their economic influence, this new channel became the lifeline of their empires. By the time the Suez Canal was constructed, the British Empire was at its height, and France was vying for global dominance. The canal served both nations as a vital tool to maintain colonial control and facilitate the efficient movement of goods, especially oil, from the Middle East and Asia to Europe. But in the grander scope of global geopolitics, the canal was more than just a physical shortcut. It became a symbol of colonial dominance and imperialist influence. For Britain, the Suez Canal was not just another trade route, it was a cornerstone of its imperial system. The British Empire's dominance in international trade was inextricably linked to the ability to control key shipping routes, and the Suez Canal was a vital artery in that system. The British Navy and merchant fleets relied heavily on the canal to facilitate the transportation of goods, particularly oil from the Middle East to Europe. But the British also had direct political and economic control over the canal. The Suez Canal Company, originally set up by French engineer Ferdinand de Lesseps, was under the influence of Britain and France. Both countries had significant stakes in the canal's operations, and this control reinforced their imperial dominance over Egypt and the broader Middle East. The canal was not just a means of trade, it was a geopolitical weapon, wielded by Britain and France to maintain their influence over the region. By the time World War II came and went, the Suez Canal remained a symbol of European power in the Middle East. But after the war, things began to change. The British Empire was no longer the global superpower it once was, and Egypt, under the leadership of Gamal Abdel Nasser, sought to assert its independence and control over its resources. The stage was set for a confrontation that would reverberate across the globe, affecting not just political power but financial stability as well. Fast forward to the mid-1950s. The world was undergoing a shift. World War II had left Europe in tatters, and new global powers were emerging. The United States and the Soviet Union were in the midst of the Cold War, and many former colonies were seeking independence from their colonial rulers. In Egypt, this rising tide of nationalism was embodied by Gamal Abdel Nasser, who came to power in 1952. Nasser, who would later become one of the most prominent figures in the Arab world, was committed to the idea of Egyptian sovereignty and independence. He was determined to challenge the existing order, not just in Egypt, but across the Arab world. One of his first and most bold moves was to nationalize the Suez Canal in July 1956. For Nasser, nationalizing the canal wasn't just about asserting Egypt's control over a crucial piece of its own infrastructure. It was also about rejecting Western imperialism and asserting a new era for the Middle East. However, this move was seen as a direct threat to Britain and France, both of which had long held interests in the Suez Canal. For the West, Nasser's actions were not just an affront to their political and economic interests, they were a challenge to the entire global order. At the heart of the Suez Crisis was the political and financial calculus that influenced the decision-making of the global powers. While the political implications were clear, the financial stakes were just as high, if not higher. The Suez Canal was more than just a piece of land. Its control meant access to vital economic resources, particularly oil. In the post-World War II world, oil had become one of the most important commodities in the global economy. The Middle East, with its vast oil reserves, had become the focal point of international trade and energy security. For Europe and the United States, securing access to Middle Eastern oil was of paramount importance. The Suez Canal was the most efficient way to transport oil from the Persian Gulf to Europe, making it a vital piece of infrastructure for the Western powers. But Nasser's nationalization of the canal threatened to disrupt this crucial supply line. The financial ramifications were immediate. As soon as the announcement was made, the global oil markets began to react. The price of oil spiked, and nations that relied on the canal for oil shipments feared that their energy security would be compromised. The ripple effects of Nasser's actions would not only impact oil prices, but would also have far-reaching consequences on global trade and the financial markets. In response to Nasser's nationalization of the Suez Canal, Britain and France, along with Israel, launched a military intervention. The goal was to seize control of the canal and remove Nasser from power. This military operation, known as the tripartite aggression, was seen as an attempt to restore Western dominance over the canal and prevent Egypt from challenging their economic interests. However, the military response was not just about territorial control, it was also about maintaining the financial order that had been in place since the canal's construction. The financial interests of Britain and France were directly tied to the control of this vital trade route. Without the canal, their economies would be severely impacted, especially given the importance of oil and shipping in post-war Europe. But the military intervention was met with fierce international opposition. The United States under President Dwight Eisenhower strongly opposed the action, primarily because it risked escalating the conflict during the height of the Cold War. The Soviet Union also condemned the military action, threatening to intervene if necessary. Under intense international pressure, Britain and France were forced to halt their military operations, and the United Nations quickly intervened to broker a ceasefire. While the military action itself ended in failure for Britain and France, the financial consequences were far from over. The Suez Crisis had thrown the global economy into turmoil, and the ripples of the conflict would continue to be felt for years to come. The Suez Crisis was not just a military conflict. It was a financial battle that would have lasting implications for the global economy. The nationalization of the Suez Canal by Nasser was a pivotal moment in the history of global trade, and it exposed the vulnerabilities in the international financial system. As Britain, France, and Israel sought to reclaim control over the canal, the true impact of the crisis was felt not just on the battlefield but in the markets, oil prices, and the very structure of the global economy. We will dive deeper into the financial fallout from the Suez Crisis, examining how the conflict disrupted global trade and markets, and how it set the stage for a new world order in international finance. Stay tuned as we explore the economic repercussions of this pivotal moment in history and its lasting legacy on modern global trade. As the dust settled after the dramatic nationalization of the Suez Canal by Egyptian President Gamal Abdel Nasser in 1956, the world watched as tensions escalated to a full-blown military intervention by Britain, France, and Israel. What seemed like a straightforward geopolitical conflict quickly transformed into a significant global financial upheaval. This intervention, which aimed to regain control over the canal and remove Nasser from power, not only marked a turning point in global politics, but also shook the very foundations of the international financial system. The Suez Crisis was more than a battle over land, it was a battle for the global economic order. To understand the deep financial ramifications of this event, it's crucial to break down the response from key players, the immediate financial fallout, and how the global economic system was tested in ways that continue to shape the world today. In response to Nasser's nationalization of the Suez Canal, Britain, France, and Israel launched a coordinated military operation in late October 1956. The plan, known as the tripartite aggression, was intended to take military action to force Nasser to relinquish control over the canal and restore the Western powers' dominance in the region. But this intervention wasn't just about military dominance. It was about economic control. Britain and France had significant interests in the Suez Canal. For Britain, the canal was a key artery for transporting oil from the Middle East to Europe. For France, it was vital for both oil and shipping trade with its colonies in Africa and Asia. The canal was not just a physical passage. It was the linchpin in the broader structure of international trade, and these European powers were determined to maintain their influence over it. Israel, also concerned about the rising power of Egypt in the region, had its own strategic reasons for joining the operation. Israel viewed Nasser's growing power as a direct threat to its security, especially with Nasser's support for militant groups in the region. Israel's military role was largely seen as a way to gain Western support for its interests, and it provided the initial military push toward the canal. The military assault began with airstrikes on Egyptian positions, followed by a ground invasion by British and French forces. The strategy aimed at capturing the canal zone and forcing Nasser to back down. However, the military response was met with unexpected challenges. While the operation was initially successful in terms of military objectives, the international backlash was swift and severe. The United States, under President Dwight D. Eisenhower, strongly opposed the military intervention, primarily because of the Cold War dynamics and the potential for further Soviet involvement. The U.S. feared that escalating tensions could lead to a broader conflict with the Soviet Union, which was already active in supporting Egypt. Eisenhower's administration, seeking to maintain peace in the Cold War context, condemned the military action and called for an immediate ceasefire. At the same time, the United Nations quickly intervened, pushing for an end to hostilities and calling for peace talks. By December 1956, Britain and France, under significant international pressure, were forced to accept a ceasefire. The military operation had failed to achieve its primary objectives, but the financial consequences of the crisis were just beginning to unfold. The immediate financial fallout from the Suez Crisis was felt across the globe, especially in markets dependent on oil and international trade. As news of the military conflict broke, global investors and traders reacted with panic. The Suez Canal was not only a key military and political asset, but also a vital trade route for oil and goods. With the canal's closure and the uncertainty surrounding Egypt's control, global trade was thrown into turmoil. One of the most immediate financial consequences of the Suez Crisis was the sharp spike in oil prices. Before the nationalization of the canal, the Suez was a crucial route for oil shipments from the Persian Gulf to Europe. The canal allowed oil tankers to avoid the lengthy and costly detour around Africa's Cape of Good Hope. However, with the closure of the canal during the military intervention, oil shipments were forced to take longer routes, resulting in a significant disruption in the global oil market. The disruption in oil flow caused oil prices to skyrocket. In the short term, it created severe supply shortages in Europe and beyond, forcing countries to scramble for alternative routes or suppliers. In some cases, nations had to secure oil from more distant sources, further driving up the cost of energy. As oil prices rose, the financial markets began to feel the effects. In the U.S., the stock market experienced sharp declines as investors feared that the conflict would spread and cause further instability in the global economy. The increased cost of energy also put pressure on manufacturing and industrial sectors that depended on cheap oil, driving up production costs and reducing profit margins. Beyond oil, the Suez Canal was a major artery for the global flow of goods. From consumer products to industrial machinery, the canal facilitated the rapid movement of trade between Europe, the Middle East, and Asia. With the canal closed, trade routes were severely disrupted. Goods that would normally flow through the Suez had to take longer, more expensive detours around the southern tip of Africa, or rely on air transport, which was not feasible for bulk commodities. This disruption had a ripple effect across global economies, particularly in Europe, which relied on the Suez for trade with the Middle East, India, and Southeast Asia. In the aftermath of the crisis, trade stagnated as companies faced delays and higher costs in moving goods. For industries relying on just-in-time supply chains, the Suez Crisis illustrated how vulnerable the global economy was to disruptions in key trade routes. The uncertainty surrounding the conflict and the possibility of its escalation to a full-scale war sent shockwaves through global financial markets. Investors were unsure how long the disruptions would last or whether the conflict would lead to broader instability in the Middle East. This uncertainty created widespread financial panic. Stock markets saw sharp declines across Europe, the US, and Asia, as investors scrambled to protect their assets. The financial panic was so intense that central banks in major economies began to intervene to stabilize their currencies. The global financial system was put to the test. The confidence that had been built in the post-World War II order seemed fragile, and many investors began to question the security of international trade and the future stability of financial markets. The Suez Crisis highlighted the dangers of relying on a single vulnerable trade route and exposed the fragility of the global economic system. While the military failure of Britain and France in the Suez Crisis marked the end of an era for colonial powers. The economic and financial fallout set the stage for a more profound shift in global power. In the wake of the crisis, the United States emerged as the dominant global superpower, not just in military terms but also in economic influence. The U.S. was already a major player in the global financial system, but the Suez Crisis solidified its role as the world's financial leader. President Eisenhower's decisive opposition to the military intervention was an indication that the U.S. would no longer be willing to tolerate colonial-style interventions in the Middle East. The financial community, which had been rattled by the Suez Crisis, looked to the United States for stability and leadership. The U.S. became the new center of global economic influence, with its currency, the dollar, becoming the dominant reserve currency. For Britain and France, the Suez Crisis marked a dramatic shift in their global status. The failure of the military intervention exposed the limitations of European power in the post-World War II world. The once great colonial empires were no longer able to exert the same level of influence over global affairs. The Suez Crisis was a clear signal that the colonial era was coming to an end, and that the global economic order was shifting away from Europe and toward the United States. The financial consequences of the crisis were particularly harsh for Britain and France. The cost of military operations, combined with the economic damage caused by the disruption of trade, left these countries in a weakened financial position. In the years that followed, both nations began to withdraw from their former colonial holdings and shifted their focus toward rebuilding their economies. The financial lessons learned from the Suez Crisis had lasting impacts on how nations would approach global trade and energy security in the decades to come. The crisis made it clear that no single country or trade route could be allowed to control global commerce in such a way that its disruption could cause global chaos. One of the most profound effects of the Suez Crisis was the heightened awareness of energy security. The world's dependence on Middle Eastern oil was laid bare during the crisis, and in the years that followed, nations began to diversify their sources of energy. Countries that had relied heavily on oil from the Persian Gulf sought to reduce their vulnerability to supply disruptions by seeking alternative sources of energy, such as nuclear power and securing alternative oil routes. The Suez Crisis also contributed to the rise of OPEC, Organization of the Petroleum Exporting Countries, which became a key player in regulating oil prices and managing the global supply of oil. As a result, the Suez Crisis helped to solidify oil as one of the most politically and financially important commodities in the world, and nations began to adopt more strategic approaches to managing their energy needs. In the aftermath of the crisis, the international financial system underwent significant changes. The dollar emerged as the undisputed global reserve currency, and institutions like the International Monetary Fund, IMF, and the World Bank became more prominent in managing international financial relations. The dominance of the US dollar in global trade was cemented, and the financial markets were reshaped to reflect the new reality of American economic hegemony. The Suez Crisis also laid the groundwork for future financial crises. By highlighting the vulnerabilities of global trade, it set the stage for future challenges in the areas of energy, trade routes, and financial regulation. In many ways, the Suez Crisis was an early warning of how fragile the global economic system could be in times of geopolitical conflict. The Suez Crisis was not just a military conflict, it was a financial earthquake that reshaped the global economic landscape. The consequences of this event were felt not only in the immediate aftermath, with rising oil prices, disrupted trade, and financial panic, but also in the long-term shifts in global power. As Britain and France faced the end of their colonial empires, the United States emerged as the undisputed leader of the global financial system. We will explore how the financial and geopolitical lessons of the Suez Crisis continue to shape the modern world. From the way nations manage energy security to how global trade routes are controlled, the Suez Crisis serves as a reminder of the fragility and interconnectedness of our global economy. The Suez Crisis of 1956 stands as one of the defining moments of the 20th century, not just in geopolitical terms but in economic and financial terms as well. We explored the origins of the conflict, its immediate financial consequences, and how the response from the global powers led to a radical shift in the economic balance of power. But perhaps the most profound consequence of the Suez Crisis wasn't just the military or political fallout, it was the fundamental reordering of the global economic system. The shifting control of vital trade routes, and the broader impact on global finance that we continue to see today. In this final part, we will examine how the long-term consequences of the Suez Crisis shaped the future of global trade, finance, and energy, setting the stage for the world we live in now. From new power dynamics to the evolution of global institutions, the Suez Crisis left a legacy that would go on to influence international relations, economic policies, and global trade for decades to come. At the heart of the Suez Crisis was a struggle for power. The control of the Suez Canal wasn't just about a strategic waterway. It was about the control of the Middle East and its resources, particularly oil, which had become the lifeblood of the global economy. The military intervention led by Britain and France, in collaboration with Israel, marked the end of an era for these two colonial powers. The defeat and the international condemnation they faced revealed the declining influence of Europe in global geopolitics. In the aftermath of the crisis, the United States emerged as the dominant global power, both militarily and economically. Although the U.S. was not directly involved in the military action, it played a critical role in halting the conflict. President Dwight D. Eisenhower's decision to pressure Britain and France into a ceasefire was a decisive moment that showed the world that the U.S. was the true leader of the Western world. This shift marked the beginning of a new global order. The U.S. had already begun to exert its influence in Europe and beyond after World War II, but the Suez Crisis solidified its position. No longer could Britain and France maintain their colonial empires or their control over key global trade routes. The Suez Crisis was a pivotal moment in the post-colonial world, and it ushered in a new era of American dominance. The Suez Crisis wasn't just a political battle, it was also an economic one. The financial fallout from the crisis highlighted the vulnerabilities in the global economic system. The Suez Canal had been a vital artery for the global flow of oil, and its temporary closure caused significant disruptions in oil markets. In the immediate aftermath of the crisis, the price of oil soared as nations scrambled to secure alternative routes for oil shipments. Oil was no longer just a commodity. It had become a strategic resource that could disrupt global economies if access to key trade routes was threatened. This realization shifted how countries viewed energy security. Before the Suez Crisis, the reliance on the canal for oil transportation was a given. After the crisis, however, nations sought to diversify their energy sources and transportation routes to avoid the vulnerabilities that had been exposed. This led to the construction of new oil pipelines and a push for greater exploration and development of alternative energy sources. The Suez Crisis also spurred the creation of more robust international mechanisms to manage energy resources. Organizations like the Organization of Petroleum Exporting Countries, OPEC, became more influential, and the crisis underscored the need for greater cooperation among oil-producing countries to stabilize supply and control prices. For global trade, the Suez Crisis marked a turning point. The disruption of one of the world's most important trade routes made it clear that the global economy could no longer depend on a single artery for the transportation of goods and resources. After the crisis, nations began to focus more on the diversification of trade routes and the development of new infrastructure to reduce their reliance on vulnerable choke points. Like the Suez Canal, the shipping industry itself underwent significant changes. As countries sought to protect their supply chains from future disruptions, they invested in alternative routes and technologies. The development of new and larger ships that could bypass the canal by taking the longer route around the Cape of Good Hope was one such innovation. Similarly, the increased use of air freight in certain industries, particularly for high-value or time-sensitive goods, further reduced the dependency on maritime trade routes. These changes in the global trade infrastructure were essential in reshaping the modern global economy, laying the groundwork for the increasingly complex and interconnected international trade system that we see today. Perhaps the most lasting financial impact of the Suez Crisis was the acceleration of the U.S. dollar's dominance as the global reserve currency. Before the crisis, the world's financial system was still anchored to the British pound. But the crisis revealed that the U.S. was now the preeminent global power, both politically and economically. As global trade became more complex and interdependent, the U.S. dollar emerged as the currency of choice for international transactions. The U.S. had already played a leading role in creating the Bretton Woods system, which established the dollar as the central currency for global trade. The Suez Crisis reinforced this arrangement, and by the early 1960s, The dollar had become the backbone of the global financial system. This shift also led to the rise of global institutions like the International Monetary Fund, IMF, and the World Bank, which played increasingly significant roles in managing global economic stability and overseeing international financial transactions. These institutions, established after World War II, were strengthened by the lessons learned from the Suez Crisis, and they would go on to play pivotal roles in shaping global financial policies in the years to come. The Suez Crisis left a legacy that extended far beyond the immediate financial and geopolitical consequences. The lessons learned from this conflict continue to shape international relations and economic policies to this day. Let's take a closer look at some of the most important geopolitical and financial lessons from the crisis. 1. The fragility of global trade routes. One of the most significant lessons from the Suez Crisis was the vulnerability of global trade routes. The canal was a lifeline for the international shipping industry, and its closure revealed how easily global trade could be disrupted. Today, this lesson continues to resonate in the context of modern trade routes. From the Strait of Hormuz to the South China Sea, the protection and diversification of global trade routes remain a priority for many countries, and the Suez Crisis remains a cautionary tale of how a single geopolitical event can have cascading effects on the global economy. 2. The shift from colonial powers to global institutions. The decline of British and French influence in the Middle East and the rise of the United States as the leading global power were both direct outcomes of the Suez Crisis. This shift marked the end of the colonial era and the rise of new international institutions that would shape global politics and economics in the 20th century. The establishment of the United Nations as a global peacekeeping body, as well as the strengthening of organizations like the IMF and World Bank, reflected this shift. These institutions were tasked with managing not only global financial stability, but also the complex political and economic relations between newly independent nations and the established powers. 3. The central role of the US dollar. As we've seen, the Suez Crisis played a pivotal role in solidifying the US dollar's status as the world's reserve currency. This shift, which began during and after the crisis, continues to define global financial systems today. The dollar's dominance in international trade, coupled with the development of US-led financial institutions, established a system that has remained relatively stable since the mid-20th century. Today, global markets continue to depend heavily on the US dollar for international trade and investment. The legacy of the Suez Crisis and the subsequent rise of US financial dominance is still visible in the way the world interacts with the dollar, as well as in the influence the US exerts over global financial systems. The Suez Crisis was not just a brief geopolitical event. It was a defining moment that reshaped the future of global trade, finance, and geopolitics. From the immediate financial shockwaves that rippled through the oil markets to the longer-term shifts in global power dynamics, the crisis highlighted the vulnerabilities of the global economic system. The US emerged as the dominant global power while Britain and France's colonial influence waned. Moreover, the Suez Crisis set the stage for the evolution of global trade infrastructure, the diversification of energy sources, and the rise of the US dollar as the cornerstone of international finance. Today, as we navigate modern financial challenges such as trade wars, energy security concerns, and global financial instability, the legacy of the Suez Crisis remains a constant reminder of how fragile and interconnected our world is. The financial and geopolitical lessons of the Suez Crisis continue to shape how we think about trade routes, energy security, and the power dynamics between nations. This forgotten financial battle serves as a testament to the complexities of global economics and the ongoing evolution of the world's financial systems. The Suez Crisis may have been a moment in history, but its lessons are timeless and continue to resonate in the modern world.